when we are looking at structuring is the jurisdiction in which to have the holding company. And most of the deals I've seen here in Africa in the past, the holding companies have been situated in Mauritius. And the main reason for that is because of the double tax treaty network. I think currently Mauritius has about 42 or 46 double tax treaties, which is quite wide. And for example, Uganda is one of the countries that we have a double tax treaty with Mauritius. And then definitely, other than the double tax treaty network, then you look at the tax regime where you are going to put your holding company. In Uganda, the tax rate is 30%, Kenya 30%. Most of the countries actually across Africa, the corporate tax rate is 30%. But you look at some jurisdictions like Mauritius, it's 15%. And which can be reduced further depending on how, where the income is coming from and what type of income it is. So, the double tax treaty network is key to look at when you are determining where to structure and have your holding company. Uganda currently, we have double tax treaties with 8 countries which are listed there, including Mauritius. But the importance of these double tax treaties is one, to ensure that where you are putting your holding company, if you repatriate profits, then you are going to take benefit of lower tax rates. For example, in Uganda, the withholding tax rate on dividends, on interest, on royalties, on management fees is generally 15%. However, if you have a holding company in a jurisdiction where we have a double tax treaty, then you may get benefit of lower rates, which in our case, generally, the lower rate would be 10%. For example, in Kenya, Kenya has with 6 countries, and also the rates, if for example, for Kenya, if it's a non-treaty country where you put the holding company, dividends would be at 10%, interest at 15%, royalties at 20%, management fees at 20%. But if you put a holding company in a jurisdiction where they have a double tax treaty, you can have withholding tax at lower rates as low as 10%. However, as we consider jurisdictions for holding companies, it is important for us to note that a number of countries now have put in clauses within their laws, their local laws, to limit benefits. That is, limitation of benefits clauses. For example, in Uganda, we have in our local laws, that is the Income Tax Act, Section 88(5), which limits application of double tax treaty lower rates unless the company which is in that jurisdiction can pass the following tests. That is the beneficial ownership test and the economic substance test. The beneficial ownership test, we had a recent change in our law, effective 1st July, whereby now they look at the individual owners. So, for example, if I have a holding company in Mauritius or in Malta or in South Africa, they will look at this holding company and they will check whether it is resident in that country. So, generally, there are certain provisions to check residence of an entity. Is it incorporated in that country and so on? But now, with the current provisions we have, which generally are trying to limit treaty shopping, they will go beyond the fact that this entity is resident in that country. They will look at the ultimate individual shareholders. So, if the ultimate individual shareholders are not residents of that country, then this treaty benefit may not be applicable. So that means in the past, when we are doing structuring, you have, let's say, a holding company in Mauritius. Then on top of it, you have another holding company. So that when they lift the veil, they're also looking at another resident holding. So, but with this new provision that we have, where they are looking at individuals, so they are lifting the veil up to the individual owners. In which case, to the extent that the individual owners are not residents of that country, then you may have a problem to apply the treaty rates. Then the economic benefit test, whereby they check whether that entity has economic substance in that country. Do they have an office? Are there activities that, do they have bank accounts in that country? And so on. So that is not just an SPV, a special purpose vehicle. Then a place of effective management also needs to be taken into consideration. Because sometimes you have a holding company to which in a country, let's say you have a DTA, but when actually that holding company is just a special purpose vehicle and the place of effective management is somewhere else. So in that case, where the actual management takes place, that could be taken to be the actual owner of that income that is attributed to this other entity which is being managed from outside. And the tax authorities in that country where there is place of effective management, they may claim tax on the income as if that was a PE, a permanent establishment in that country. Then permanent establishment risks. A number of countries have put in place laws which are exposing, let's say, holding companies to having a permanent establishment in countries where they hold subsidiaries and branches. For example, we have service permanent establishments now. I'll give an example of Uganda. Within our law, we have a provision that says if a non-resident entity sends its staff and they come and provide their services in Uganda for more than 90 days, that can create a service PE, that is a service permanent establishment. In which case, that company that has sent their people can be considered or deemed to have a permanent establishment here, whereby the income they're generating out of that service is taken to have been generated in Uganda, whereby that entity would have to register for taxes here, and instead of, let's say, that income suffering 15%, they will be required to register here and then make a return to the tax authorities. Then intellectual property holding. This should be looked at mainly from a transfer pricing perspective, because For intellectual property, we are normally charged, you normally find, let's say, holding companies or group companies having charges for intellectual property. But the question is, the charge for intellectual property, let's say to a subsidiary or to a branch that you have acquired, you have created after acquisition, how much are you charging? Is it at arm's length or not? And in checking arm's length, there's what we call the DEMPE concept. So the DEMPE concept looks at how this intellectual property arose, and essentially we look at the functions performed, the assets used, and the risks assumed by each of the entities to check whether the intellectual property amount that is being charged, or the charge for intellectual property, is sufficiently well evened out among the group entities. So some of the things under the DEMPE concept, we look at who developed this intellectual property. Where are the key people that were involved in development of the intellectual property? If the intellectual property was developed, let's say, a few years back, who is responsible for its enhancement? Who is putting in more money or more resources to enhance it? Who is responsible for its maintenance and protection? Because whoever developed or is responsible for its maintenance and enhancement then should have more rights to it, and as such should deserve more income for it. So under the current BEPS, which is base erosion and profit shifting, which is a key topic from a transfer pricing level among group entities, it is important to check that if intellectual property is going to be charged, then those issues are looked at to avoid transfer pricing risks. Then capital structuring risks also need to be taken into account from a tax perspective. Generally, when you are going into mergers and acquisition, we look at sourcing of financing or use of a financing that we are going to put in the different entities. And in most cases, debt financing is more tax efficient. Why? If I finance an entity through debt, one, I'm entitled to interest. And that interest, I'm entitled to it whether the entity makes a profit or not. It will be dependent on what we agree. And on that interest, the charge is at 15%. And then that interest will be an allowable expense if it meets certain provisions of the law. So, as we are looking at the financing, we need first of all to know what level of financing or debt financing we need to have in a given entity. And then we also need to know that that interest will be subject to withholding tax, which would be either 15% for most of the jurisdiction, it may go up to 20% in some, or if the Dow tax treaties apply, it may be at a much less rate. Then, as we look at also debt financing, we need to be aware that the interest we charge, if that debt financing is coming from a group entity, will be subject to transfer pricing reviews to check whether it is at arm's length or not. That means if you had picked this loan from a third party or from a bank, would you be paying interest at the rate that your group entity is charging you? Then there are countries that have deemed interest provisions. For example, Kenya. it has a deemed interest provision, whereby if you say I'm going to give an interest-free loan, then they will deem you to have earned interest, in which case then provisions of withholding tax and so on may apply. Then the other one is equity financing, and it also has its tax implications. If you do equity financing, that means you'll be paying the shareholders through dividends, which attract withholding tax in most of the jurisdictions at rates as high as 15% in Uganda or lower, where we have other DTAs. Then thin capitalization consideration also have to be put in place. As I said, debt financing is better than equity financing from a tax perspective. So you find that from a structuring perspective, a number of entities in the past used to have much more debt than the equity, given the advantages of debt financing. But within a number of jurisdictions now, we have thin capitalization rules that limit the amount of interest that is going to be allowed in the books of the local entity. For example, in Kenya, they have I think debt to equity ratio now is 3:1. In Uganda, we had 2:1, which was changed recently, and now they are saying if you have debt, if you are a group company and you have debt, the maximum that will be allowed in the books of the local entity will be 30% of tax EBITDA. That is 30% of tax earnings before interest, tax depreciation, and amortization. Anything above 30% will not be allowed as an expense. If the entity here makes a loss at the end of the year, that means all the interest that will be charged to that entity will not be allowed as an expense for tax purposes. And it is a little bit more stringent because it's no longer looking at only interest from group entities. It is even looking at interest from financial institutions. As long as it's a group entity, then the interest, all interest, will be checked for this limitation. Other considerations that we need to take into account is capital gains tax. On disposal of a share or property in the host company, there is capital gains tax in a number of countries. Kenya now has capital gains tax, Uganda has capital gains tax, and many other countries have capital gains tax to the tune of 30% in Uganda. So if you dispose of shares, then you need to check how much capital gains tax may arise and who is going to take responsibility to pay it. Is it the seller or the buyer? In most cases, it should be the seller, but that needs to be clear. Then stamp duty considerations on transfer of shares or assets. Stamp duty arises, which can be at in some countries it is a percentage. In other countries it is a fixed amount of stamp duty that you have to pay. So it's also key to know who is going to take responsibility. Then you need to check whether the credits or liabilities are transferable. In most cases, if it is a share deal, the credits and liabilities are transferable. Asset deal, generally, they are not, because the tax credits remain with the entity that originally was there. So if it is a new entity, they may not be transferred. And the extent of those credits need to be looked at. Then transfer of tax losses. When you acquire an entity, it is important to check whether the tax losses are transferable. Because when we are doing the tax due diligence, one of the aspects that leads to deferred tax would be the tax losses that an entity has. However, there are a number of countries now that limit the transfer of tax losses. First of all, if it is an asset deal, the losses will not be transferred, generally. If it is a shared deal, generally the losses will definitely go to even the new owners will enjoy the tax losses. However, a number of countries have provisions within the law that limit when tax losses can be transferred. I'll give an example of Uganda. If you make an acquisition of an entity here, then, and there's change of ownership by more than 50%, then you cannot transfer tax losses unless the entity that you have acquired continues dealing in the same business for at least 2 years. So, which means if you change the business right away, then those tax losses will not be allowed to be carried forward. And that also applies to some other jurisdictions. And then other jurisdictions have a limitation of carry forward of losses. Like Tanzania, I think it's 7 years. So, if it is important then to check the tax losses that are in the books, when did they arise? To the extent that you have tax losses still in the books that arose more than 7 years ago, then that means you never get any benefit out of them. That same provision had been brought into the proposals in the bill of tax changes in Uganda recently this year, but it was dropped at Parliament level, so it did not pass. So it is important to check whether those assets exist. Then the other considerations is in respect of entry. That means once you have acquired, what do you need to take into consideration up to the point of exit? And during the time when you have acquired an asset, what issues do you need to take into consideration to ensure that you grow your value into that organization so that is not eroded? It's important that you understand the relevant industry and the client-specific tax issues, because by that understanding is the only way you make sure that you manage your tax risks. Then, payment subject to transfer pricing considerations. For example, whenever you are making a transfer of management fees, or whenever you are having an agreement on royalties that you are going to charge, or interest you are going to charge on loans to the entity that you have acquired, please make sure that you ensure that they are at arm's length. Please make sure that you have a transfer pricing policy in place. This will limit the possible exposures to adjustments that may arise in the subsidiary and also in your holding company, because now transfer pricing cuts across all countries, whereby if that is not well managed, then you find that the costs you think were allowable to a company are not, and this will come with, of course, principal tax liabilities and penalties. And in some jurisdictions, penalties are very, very high and are compounded, so you find that the penalties are even higher than the principal tax, and it erodes the value of the company. then it's important to ensure that you build the internal capacity of the management to ensure that the tax risks are well managed through trainings, and also ensuring that you have an enterprise resource planning system that takes into account all aspects of tax planning. I also note, at the beginning I said at the due diligence stage, check the quality of the consultants that you have engaged. Also at this stage, check that you have external consultants who give you an independent view and a correct view for purposes of proactive management of your tax affairs. And it is important also to manage tax audits appropriately. In many instances, in my few years of service in tax, I've noted that the way you manage tax audits with the tax authorities is important. How you provide information when requested, what kind of information you provide to them, and which people you allow them to deal with during the audit, and how you deal and engage, because sometimes businesses just leave it either to very junior people to engage, and they give information which may not be the correct information. And at the end of that day, changing the taxman's mind becomes extremely difficult, because then they will require a lot more documentation that you may have. So that is key to manage well, not to erode the value of your business. Then at the point of extraction of profits, these are the key considerations that you need to make. Normally, your profits can be extracted through dividends, royalties, management fees, and interest. But each of these have certain liabilities that you need to take care of. First of all, from a tax perspective, make sure that they are at arm's length. That is, the meeting the transfer pricing requirements in your country. The only one among these is dividends normally, which is not tested for transfer pricing. Make sure that the applicable withholding taxes have been taken care of. And some of these also have VAT requirements. For example, management fees. There's what we call reverse VAT in a number of jurisdictions now, whereby if I'm paying management fees in addition to withholding tax, which is 15% generally, which has to be withheld, there is VAT on imported services or reverse VAT. In some jurisdictions, reverse VAT is not a cost. That means you pay it and you claim it. That is, the entity that receives the money, that pays the management fees, has to account for reverse VAT and then claim it. So it is not a cost. In some jurisdictions like Uganda, reverse VAT is a cost. So when you are paying management fees, the entity paying management fees, you have to account for 18% VAT, and that is a cost to the local entity because it cannot be claimed back under the input-output arrangement. Then we need to know the definition of dividend in a number of tax laws. For example, here in East Africa, Uganda and Kenya, the same. The definition of a dividend can be expanded to include any amounts incurred by a company on behalf of a shareholder or a related person. So, if on behalf of a shareholder, the entity here pays someone, that would be treated as a dividend, which requires dividend withholding tax. CGT considerations, as I said, at the point of exit, in most instances, capital gains tax will arise, especially if it's a share deal. And that can be as high as 30% in a number of jurisdictions, like Uganda. And capital gains tax